Hey there! Bitcoin breaks above resistance. Everyone enters. Breakout traders rush in. Short sellers get stopped out. Social media turns euphoric instantly. Bitcoin is finally breaking out. New highs incoming. Don't miss this move. Sam's heart starts racing because this is the move everyone has been waiting for. The green candle explodes upward, and in that moment, Sam feels the same emotion most traders feel during breakouts: fear of being left behind. So he buys, aggressively, and for a moment, everything looks perfect. Then suddenly, Bitcoin violently reverses downward. The breakout completely fails. And once again, Sam is trapped. Now he's staring at the chart in disbelief. Because this keeps happening. Price breaks above resistance. Then reverses. Price sweeps below support. Then reverses again. At first, Sam thought it was random, but eventually, he notices something strange. The reversals keep happening around the same types of levels: equal highs, equal lows, previous highs, previous lows, places where traders naturally place stop losses. And that's when Sam discovers liquidity, the hidden fuel behind market movement. Imagine a clean resistance level. Price touches it once, rejects, then again, rejects again. Now every trader on the internet sees the same thing. Resistance. Some traders place sell orders there. Others place breakout buys above it. And almost all of them place stop losses in nearly the same location, right above the highs. Without realizing it, they're all creating liquidity, a giant pool of orders resting above the market. And suddenly, Sam sees the chart differently. Retail traders see resistance, but institutions see a money zone, a pool of liquidity waiting to be collected. And for the first time, Sam realizes something uncomfortable. Every time a trading guru says, "Place your stop loss just above the highs," thousands of traders place orders in the exact same location. The market now knows exactly where the liquidity is resting. Like a bullseye. One morning, Bitcoin forms perfect equal highs. The level looks obvious. Too obvious. Social media becomes extremely bullish. Once this breaks, Bitcoin explodes higher. Sam feels the excitement immediately. This time, he thinks he's finally ready. Price slowly pushes higher, closer and closer, toward the equal highs. The tension builds. Then suddenly, one aggressive green candle violently explodes above resistance. Breakout traders instantly enter. Short sellers get liquidated. The entire market becomes emotional at the exact same moment. Sam's heart is racing. He thinks, if I don't buy now, I'll miss the move. So he enters, exactly where everyone else enters, and then Bitcoin violently reverses downward, instantly. The breakout was the trap. The equal highs were the target. And suddenly, Sam realizes something deeper. The market didn't use logic to trap traders. It used emotion, hope, FOMO, urgency, because emotional traders create predictable liquidity. And suddenly, Sam understands something most traders never realize. Equal highs are not just resistance. Equal lows are not just support. They are liquidity pools, places where emotions become predictable. Fear places stop losses below lows. Greed places breakout entries above highs. And the market knows exactly where both are resting. Think of liquidity like a magnet or a vacuum. Highs and lows are not walls that stop price. They pull price toward them. Because the market is constantly searching for available orders, it stays inside ranges until enough liquidity builds above or below the structure. Then suddenly, price attacks the liquidity aggressively. And for the first time, the market starts feeling mechanical instead of random. But then Sam notices something even more important. The liquidity sweep itself isn't the entry. This changes everything. Because beginners usually trade the sweep. Professionals wait for the reaction afterward. Sometimes price sweeps liquidity and continues strongly afterward. Other times, the sweep completely reverses direction, and the difference between those two outcomes is structure, confirmation, behavior after the sweep. That's when Sam creates a rule for himself. The sweep is the action. The BOS is the reaction. Beginners trade the action and get trapped. Professionals trade the reaction and get paid. The sweep was never the move. The confirmation afterward was the real information. That's when Sam starts combining the liquidity with BOS and CHoCH. And suddenly, the chart starts telling a complete story. Liquidity gets collected. CHoCH warns about possible change. BOS confirms direction. For the first time, everything connects together like puzzle pieces. Structure becomes one piece. Liquidity becomes the other. And when they connect, the market suddenly starts making sense. Because now Sam understands, liquidity explains where price wants to go. Structure explains whether the market accepts or rejects that move afterward. And together, they completely change how the chart feels. One chart changes everything for Sam. NASDAQ forms equal lows during an uptrend. Retail traders place stop losses beneath the lows. The setup feels obvious. Then, price aggressively sweeps below the equal lows. Panic spreads instantly. People start calling for a bearish reversal. The old Sam would have panicked. The old Sam would have entered short emotionally. But this time, something changes. Sam almost clicks sell. Then he stops himself. He waits. Price quickly reclaims structure. Then bullish BOS appears afterward. And for the first time, Sam understands what real confirmation looks like after liquidity gets collected. The sweep was never the move. The confirmation afterward was. And quietly, the emotional trader inside him starts disappearing. Before, Sam feared stop hunts. Now, he expects them. Before, equal highs looked like breakout opportunities. Now, they look like liquidity targets. Before, the market felt manipulative. Now, it feels intentional, mechanical, predictable. And finally, Sam realizes something important. The market was never the enemy. His lack of vision was. Now, he sees everything differently. Because once you understand liquidity, you stop asking, why did the market take my stop loss? And start asking, where is the market likely searching for orders next? That question changes everything. In the next episode, Sam discovers fair value gaps, why price moves aggressively away from imbalance, why some zones get respected instantly, and why the market constantly revisits inefficient movement before continuing higher or lower. Because liquidity explains where price wants to go, but imbalance explains why price returns. If this episode changed the way you see equal highs and equal lows, subscribe to Market Classroom, and I'll see you in episode 9.